Well, Sarah, we're year one of a 3-year transformation. We've called it Path to Brilliance, 3 key strategies for Signet. Customer first, building a strong omni-channel experience, and building a culture of agility and efficiency. I'd say we're making progress. We certainly aren't there yet, but we've set a strong foundation for bolder and faster action this year.
What I'm trying to figure out, Gina, is that the sales decline, which has been going on for a long time now, does it have to do with factors that are just out of your control, that you're in the mall and mall traffic is down, that millennials aren't getting engaged as much as our parents used to? Or is this sort of an execution issue with Signet where you've got a lot of work to do on turning it around, and you can do that?
Well, there's no question that the retail environment has been challenging, not just for Signet, but for many other retailers as well. But Signet has a very strong competitive position in the marketplace. We are far and away the leading retail jeweler. We have a diverse branded portfolio with Kay, Zales, Jared, and Piercing Pagoda. And I think as we work to really update our product experience to make sure that we have a strong value-oriented assortment and bring more on-trend jewelry as well as a seamless omni-channel experience, we can definitely grow both the top and the bottom line.
How are you thinking about the balance between bricks and mortar stores and online? I know you're closing some stores in an effort to cut costs. Is that a transformational move or just around the edges?
No, it's definitely a transformational move. In fact, we announced that last year we closed more than 260 stores. This year we'll close another 150 over a 3-year period. That will be a 13% reduction in our store footprint. But despite what some people think in the jewelry business, our store footprint is a competitive advantage. About 70% of customers now are starting their journey to look for jewelry online, but more than 80% of those are purchasing in store, and that's where our store team's expertise and also our full service offering, which includes repairs, piercing, service plans, that's where Signet has real competitive advantage.
Talking to some analysts, about the various brands and the different stores that you guys have, one question that comes up a lot is, why not merge Kay and Zales? What's the big difference in the two stores and who comes into them, and why have both in terms of your footprint?
We've done a lot of research on that in the last year, and we do have different shoppers that come to Kay and Zales. Zales tends to be a more fashion-forward customer, more female self-purchasers. Kay tends to be more of a gifting customer, skews a bit more male. And so I think we have an opportunity to use our brand portfolio for our competitive advantage.
What are you seeing in this first quarter? I know that the holiday season wasn't perhaps as good as it could have been, but not terrible, and the stock's up a little bit. What's been the start of the year, and has there been lumpiness with the shutdown and things like that?
Well, we didn't guide today in our earnings call at all about where we were in the first quarter. So I can't really say kind of how it's tracking to date. But what I can say is that I think as we move through the year, we will continue to get more and more of our Path to Brilliance initiatives in place, which includes new products, a complete transformation of our marketing plan. Signet for many years has had a competitive advantage in broad-scale marketing. No other company has the scale that we do in that space. We'll take, though, some of that marketing and make it significantly more targeted, a much stronger digital and social presence than we've ever had before, which really makes our marketing both more effective and efficient. That's just one other example of the initiatives that will continue to come online throughout this year.